Data centers have a voracious appetite for electricity.
There just isn't enough power to fuel this appetite for AI demands, let alone Bitcoin.
Bitcoin hitting higher highs, traded above 118K for the very first time today.
You're seeing hyperscale capex forecasts for AI growing 65, 70% year on year.
Which is where the infrastructure players like ourselves and all the cloud service providers put the infrastructure in the cloud so that developers could use these machines to train the models. For every dollar that they spend with us, translates to $5 worth of rentals.
Together, Horizons 1 and 2 will have capacity to support over 38,000 liquid-cooled GB300s. In saying that, it's still modest compared to the capacity of our Sweetwater hub, which could support over 600,000 GB300s.
Hello and welcome to How to Invest. In today's video, we're going to be talking about IREN. It's a stock that I talked about previously in a live stream when I did a massive deep dive. And this is the 6-month chart here you're seeing on screen now. It has had an absolutely massive run over the last 6 months, going from about $5.13 a share to now trading at $37.90. So that's something like 7x or more since its bottom back in, it looks like that's April-ish it bottomed. I talked about it in June, so that's kind of the first thing I want to go over today. So I talked about it July 4th, 2025, when it was trading at July 7th, it closed at $16.95. So it was right there in that range around $16 to $17 when I talked about it. I invested in it personally. My cost basis, you can see here, is at an average price of $15.73, about an 8%, just a little under 8% of my position in my personal portfolio now. And that kind of leads into a little bit about myself as well. So I'm a stock analyst at a holding company where we have over $7 million of assets under management. And then I also have a personal portfolio of over $100,000. So just that's a little bit about me so you can understand my background. And then also, yes, so we've been talking about this stock on the channel since July. And obviously it's not in financial investing advice, but if you had invested when we talked about it on the channel, you would have already had over a 100% return. So the main question I am dealing with today is it still a good investment? So really quickly, we'll go over a little bit about the company, just going through our spreadsheet here. In essence, it's really focused on low cost renewable energy and using that low cost energy to energize compute, and then pointing that compute at whatever has the highest ROI. So historically, that has been Bitcoin mining for IREN, and more recently with this massive influx into AI infrastructure investments, they've been turning their focus towards AI data centers. So again, they are just taking the lowest cost compute and pointing towards whatever investment has the highest ROI, which makes this a very, very agile company and a little bit more difficult to define because it's not just like a Bitcoin mining company or a Bitcoin treasury company or, you know, an AI infrastructure or data center company. It's really fundamentally the owner and CEOs that I'll mention a little bit later are investors. And so you basically get to own a kick butt investing company owned by two really, really good infrastructure investors that I think if in the future AI data centers no longer becomes the highest ROI avenue, they'll be looking for the next highest ROI. So I just think they have really competent management, but we'll go into that a bit more in the future. So again, just the company's mission, basically the same as the synopsis. We are the responsible way to power Bitcoin, AI, and beyond. And that's kind of what I was just mentioning. With the beyond, they will continue to transform this company towards whatever has the best return. So we own and operate next generation data centers powered by 100% renewable energy. So their products currently is Bitcoin mining, AI data centers. They just generally, they service energy intensive industries with renewable energy. So their business model currently is to set up these data centers in remote areas of currently Canada and the United States. They have a lot in British Columbia, and they're building some new massive places in Texas, which we'll talk about more in a minute. But yeah, they just go where the power is cheap. They build the infrastructure there. And so they're able to have really, really low cost of energy So they're able to mine the Bitcoin at a cheaper cost, and then they're also able to provide data center services at a cheaper cost. So we'll talk about that a bit more later when we talk about their moat. So they're making money through selling Bitcoin and renting out their compute to AI startups and hyperscalers. So now talking about the founders, this is actually a brother-led team. So you have Will Roberts and Daniel Roberts, who are brothers. Daniel Roberts is the CEO, but we'll talk about Will Roberts really quickly. He's also a C-suite exec. He has 13 years of experience across resources, commodities, and real assets. Will was vice president at Macquarie, I'm not exactly sure I'm saying that right, group in the commodities and global markets division, and involved in debt financing and principal investments across mining projects. There's a lot of mining in Australia, which is where these guys are from, but it is headquartered in the United States now, as well as managing foreign exchange and commodity price risk. Will co-founded that company's digital asset team. And then we have Daniel Roberts, who is the CEO. He has over 20 years of experience across finance, infrastructure, and renewables. He previously exited as the second largest individual shareholder in an infrastructure fund manager company called Palisade Investment Partners, which had billions of dollars under management across 23 businesses. And prior to that, he worked with the same capital group that his brother did, and PwC across Sydney and London. PwC is, I think, another investment bank, if I remember correctly. And then Daniel is currently on the board of Jolt, which is a BlackRock-backed EV charging business, where he's also the second largest individual shareholder. His Bitcoin journey began in 2013-14, and then he went on to co-found IREN with his brother, Will Roberts, in 2018. So a few really important things. Their background is exactly in what IREN is doing. They have a background in investing, in renewables, in energy, in infrastructure, in Bitcoin, and just overall just making really good investments that get a good return on those investments. Another important thing is they also have experience in financing. So there's been some concern around IREN in the past because they have diluted in order to raise capital, in order to fund future investments. They have stopped that now and have switched completely to pretty much project financing and corporate financing, debt financing instead. So there's no more dilution, which honestly I'm a little bit sad about. I think a lot of investors get this point wrong, which is they see dilution purely as a bad thing. Now, if you have a super competent management team like you do here with Will and Daniel, dilution can actually be super accretive, which means better for investors, grow their investment for shareholders by making those investments and returning better revenue, better net income, more, asset ownership, balance sheet strength to the owners, even though they lose a little bit of ownership through the dilution. So it can still be very accretive to shareholder value. So, but if that's something you're worried about, they are not doing that anymore. So, but that's a little bit about Will and Daniel. Let's go over the bear case. So these are some of the threats, maybe risks posed to IREN. So first off, Bitcoin price could drop. Obviously, short term, we have no idea where Bitcoin price will go. I think the short term price movement of the stock and of Bitcoin doesn't really matter. But what the real risk would be is a long-term drop in Bitcoin price, talking about, some kind of transition out of Bitcoin investments from institutions. Again, I really don't see this happening. I see actually quite the opposite, but it is something to keep in mind. The next thing that is a threat or risk is that they failed to build these data centers. So they've successfully deployed a small scale kind of tester version of these data centers, but they have massive amounts of planned construction for new data centers. So obviously if they failed, if they fumbled the ball on those infrastructure projects, that would obviously be very bad for the company. Again, I don't see this happening. They built out multiple Bitcoin mining clusters, and they've had no problem with that. They've successfully deployed the test GPU kind of cluster for data center and AI, services, and they've been doing a great job, and just again with their background in investing, they know what they're doing. They have a background in infrastructure, they have a background in renewables, they are very, very competent, and they formed a very competent team around them. So just want to point those out. And that's pretty much the bull case, right? So this is the bear case. A lot of these, you flip them to the positive, and that's the bull case. So we'll go over the bull case quickly here in a second. But another thing to keep in mind is that they could fail to get the customers that want the compute, or IREN does not offer a software layer on the compute. So, maybe they're outcompeted by another data center company that offers a software layer. I'll tell you why I don't think that matters in a moment, but potentially that will be part of the reason why, or, AI as a whole could have some kind of pullback. And so, the customer base kind of goes away. So that's another risk. And another thing is they could get the customers, but the customers could be a lot of startups. Obviously, the AI is a massive new space. And so what you could see is a bunch of customers coming in. There are all these startups which are very, very speculative, and a ton of them go out of business after a couple of years. And boom, after a few years, the revenue spikes and then collapses because a lot of their customers go out of business. So that is definitely a risk. They are dependent. Obviously, they only get paid if the people they're servicing have money to pay them. So that is definitely something to keep in mind. Now, the bull case, which I think is the much more likely scenario, which is Bitcoin prices will continue to long term. I think this is the most likely scenario as we see, kind of overall adoption. We have government backing now, potentially even the US making their own Bitcoin treasury. Again, management executes AI factory build out flawlessly. As we'll look at more later, they're planning on building out up to 660,000 plus Blackwell GPUs, enabling 33 billion in annual revenue, which I'll explain the math on that in a bit. And they continue to build more facilities as they did with Bitcoin mining. So when they built their first Bitcoin mining, they used that to fund the next Bitcoin mining facility. So if they do that same kind of growth strategy for AI data centers, we could see kind of a continued acceleration where the last project funds the next project, etc., with a little bit of debt financing, like I talked about. And then well-versed founders, this is also part of the bull case, well-versed founders, like I talked about, I'll go through that, I'll pass that up a little bit. They have really cheap energy. So this is something definitely to keep in mind. A lot of these Bitcoin miners actually have a massive advantage in the AI data center build-out, because one of the biggest constraints for the AI data center build-out is energy. So a lot of these Bitcoin mining companies were actually signing contracts with energy providers. So they were locking in their energy cost rates back in like 2021 during like kind of a bear market. And so they got incredible rates locked in that, these new data center companies that are coming into the space that weren't in Bitcoin mining before, they don't have these contracts. These contracts, they guarantee that these companies get access to super, super cheap energy, something like 3 to 5 cents, I think, per kilowatt hour, versus, as a resident, like most residential rates are in like the 35-cent range. So they have 1/10 the price per kilowatt hour of electricity. And so they just have incredibly great access to incredibly cheap energy. Companies like Mara also have this advantage. So that's something definitely to keep in mind as well. So, and with the management team, again, they can point their energy towards whatever has the best ROI. In the midst of the AI boom cycle, IREN is transitioning to a data center company for AI training and building AI factories. They are able to offer better prices due to using cheaper energy at their custom-built facilities. They get long-term contracts from steady hyperscalers, not providing the software layer. As a bull case, also reduced cost, and it gears them better to serve steady hyperscalers who do not want the software layer on these data centers. They just want the bare metal, and they are signing, 10, 20-year contracts. So that is the bull case side, which I think, again, is much more likely. Now, the type of company, this is an incredibly fast grower. I believe they grew their adjusted EBITDA by like almost 400% or something. I don't think I've talked about this yet. This company type idea comes from Peter Lynch. and he just talked about a couple of different types of companies and what kind of play they are as an investment. So since I haven't gone over this before, I do want to take the opportunity to go over it here. So fast growers, it just means they're small and aggressive, and they're growing earnings typically 15+% annually. And next one is a stalwart. They're growing earnings somewhere from 5 to 15% annually. You have a cyclical, which expands and contracts based on macro. So think of like Ford, which is an auto manufacturer, which is very based on the overall macro, interest rates, that kind of thing. So a cyclical play could look like buying it near the bottom of the revenue cycle and then selling it near the top of the revenue cycle. Stalwarts you buy just for stability. Fast growers, obviously you want a massive return. There's turnaround plays, so something that maybe has been mismanaged for a while, a new management comes in and they're doing things to turn around. So still very, very speculative turnaround, but I think actually, what's the micro company here in the United States? Intel is actually could be a turnaround. That's one I'm watching. They just got new management in, and I think he is super competent. So I'm watching that one. I still need more evidence to know for sure that that might actually be a turnaround. You have things like the government investing in the company. So that is another piece to the thesis that could be a turnaround. But that was what a turnaround would be. An asset play would have been something like Open Door when it was trading at 90 cents per share. It had more shareholder equity than the total market cap, which means you got paid to buy the company. So that would be an asset play. A no grower, this is something that we definitely want to stay away from. It's just a slow 0 to 5% grower, and then growing, bankrupt, shrinking. Obviously, we do not want to invest in anything that is going to go bankrupt. That is terrible for investing. So just wanted to cover that really quick because I don't believe I've done that before in a video. So just talking about their past revenue growth a little bit, they've had high 100% plus year over year revenue growth for now over 3 years, and I expect them to have another over 100% revenue growth year this year as well. Their fiscal year just ended. Their fiscal year ends in June, which makes sense because that's the tax season for Australia, and then coming from Australia, they just aligned it with kind of the fiscal year in Australia. So this is fiscal year 26 for them now, and I expect them to have over 100% year over year revenue growth this year as well. So they just flipped to cash flow positive. So they were negative $500 million in cash flow. I believe that was last quarter. So fiscal year Q3 2025, so Q1 of this year. And this last quarter, they switched to $50 million positive free cash flow. And I would expect that continuing to shoot up, or at least staying stable as they just continue to invest more and more of that free cash flow into future infrastructure projects. Shareholder equity growth. This has actually been growing incredibly well. We love to see a strong balance sheet and a strong balance sheet that is growing very quickly. So it has been growing triple-digit percentages year over year for quite a while, a lot of quarters, until this most recent quarter, it grew only a pitiful 65% year over year, which is absolutely incredible. Obviously, I'm being sarcastic. So we love to see that shareholder growth, robust balance sheet. I would find it, as you will see when we look at the net asset value, very unlikely for this company to go bankrupt. Now, track record of execution. Great track record of executing their infrastructure build out. Sometimes they miss on expectations, but in terms of earnings per share, but only slightly. I think overall they just have a great track record of executing as a business, and that's way more important to me. Now, management is not necessarily guiding for revenue, but what they are guiding for, with not necessarily a time frame given, is building out to 660,000 Blackwell GPUs, and I will show you why that is such an incredible guidance, a better guidance than most companies give. And this is the maths for it right here. So they are scaling up to 660,000 Blackwell GPUs. Now, Blackwell GPUs are estimated to cost around $40,000. There isn't a publicly denoted price, but Blackwell's GPUs cost somewhere from $30,000 to $40,000 based on most consensus. Obviously, this is not public. So At $40,000 per GPU, and I'm taking the higher end of this because the 600,000 of those Blackwell GPUs are going to be, I believe, what's called the B300s, which is the newer generation. We'll double look at that in a second. I can actually double check that right now. Yeah, sorry, not B300, GB300. So I believe those will probably be a little bit more expensive. So I'm going to take the higher end of that range. So at a cost of $40,000 per GPU, and a return of $5 per $1 spent per GPU over 4 years. And that is based on what the actual management at NVIDIA are saying. So this is a quote from Ian Buck, the VP and General Manager of NVIDIA Hyperscale, and HPC said, quote, every dollar a cloud provider, which is IREN, spends on buying a GPU, they make it back at $5 over 4 years. So that is an incredible return on investment. So I definitely understand why Daniel is looking at these data centers, because they have incredible return profiles. So for every dollar they spend, so they're buying 660,000, paying 40,000 per, and they make $5 for every $1 they spend, divided by 4 years, obviously. That means that once they complete the 660,000 GPU build out, they will be making $33 billion in revenue. That is absolutely phenomenal. Their current trailing 12-month revenue is $501 million. That means they are going to 66 times their revenue once these data centers are all built out. So that is the big question, is what is the timeline for this? They have not given perfect kind of guidance on when that's going to happen. So when we see in my modeling, my bear case is saying it will be, somewhere in the 5 to 10 year range, these data centers will be completed. And in the bull case, it'll be in the 2 to 5 year they will be completed, and we'll be able to see the return differences there. Another thing to keep in mind for how they're achieving growth is they are investing in marketing, which is really important for acquiring these AI customers, these data center customers. They're hiring a new marketing staff, as well as really cool, they sponsored the All-In Summit recently. So really cool to see that kind of investment in marketing to procure these really, really high quality clients for their data centers. If you're enjoying this video so far, make sure to leave a like and subscribe. Just incredible what this company is doing. The market cap at the end of today, which is September 17th, is $10.308 billion, while the enterprise value, however, is only 8.5 billion, or almost 6, so 8.6 billion. And that is because they have $1.7 billion in net assets. So they have $1.7 billion of more assets than they do have liabilities. So just again, incredible balance sheet. And so really not that crazy. You're paying 8.6 billion dollars for, $33 billion of revenue in the future. And typically, these, as we'll see in terms of price to sales, you could have anywhere from maybe a 6 price to sales on the low end to maybe like a 12 price to sales on the high end. So you're talking about this company potentially getting somewhere between 33 billion at a 10 price to sales ratio, maybe a $330 billion market cap, and they're currently trading at a $10 billion market cap. So you're talking about somewhere between around a 30x in the stock price of this company, even at the current price, once they complete this GPU build out. So just incredible returns if they are successful, which I do think there is a high likelihood. So that's the 501 million trailing 12-month revenue, 342 million of gross profit, which gives them a really strong gross margin of 68%. They've negative free cash flow trailing 12 months, but like I just mentioned, this last quarter, they did flip to positive free cash flow. They did 89 million in earnings, which puts them at a actually incredibly competitive compared to competitors, 18% net profit. So really, really high. And I would love to see that continue to go higher, which I think is definitely possible just with this incredible management team. Obviously, the PE ratio is incredibly stretched in the short term, looking backwards, but looking forward, I don't think it's that ridiculous with how fast they're growing revenue and how much more that will drop to the bottom line. So we'll look at how these compare to some other companies in a moment. 12% short interest, so you can get a little bit of squeezing in the short term. But again, short-term price movements are just I think it's all noise. We really care about the long term here. So the total addressable market in 2025 for, I believe this is for AI and edge compute, like data center, maybe the whole AI market. I did this research a little bit while ago, but it's 106 billion. It's growing to 254 billion. So a really healthy CAGR of 20%. And by 2035, 613 billion projected. So I don't think it's that crazy that they would have a decent slice of that and $33 billion of revenue. So and then getting to multi-trillions in 20 years. So if they continue to execute and this market just continues to blow up, 20%, 20% CAGR for AI factories and 20% for Bitcoin, which I honestly think they will probably kind of ignore from this point forward just because the return profile is so much better in AI data centers. I think there is a ton of room for them to continue to grow even after they build out these current planned data centers and buy these current planned GPUs they're planning on buying. So obviously in the Bitcoin mining space, they're competing with Mara, Riot, CleanSpark, data centers. There's tons of data center companies. Microsoft offers data center services, Amazon, Google. You have new players like CoreWeave, which is super hot right now, and Nebius as well. Also offering data centers. But again, even with all of this competition, I just think the market is so massive. These hyperscalers have such massive, planned CapEx expenditures. They're planning on investing so much into these data centers. Literally you have competitors like OpenAI buying, I think it was from either Microsoft or it must have been Google. They're paying their competitors for, data center space because they just need so much more compute. And they're on top of that, they're also investing $500 billion in their own data centers. So I just think this is one of those things where there's just so much more demand than currently built infrastructure. There's so much room for so many players to grow like crazy, like I think IREN is going to. Now, on top of that, I do actually think that they have a little bit of a moat. So like I mentioned, these companies sign contracts. So you have contract switching costs. You also have the contracts for these low cost of energies. So you have low cost production moat as well, because these Bitcoin miners signed all of these incredible energy contracts back in 2021, 22-ish. So yeah. They have a preferred partnership with NVIDIA. I don't know how hard it is to actually get to a preferred partnership with NVIDIA, but basically what the preferred partnership says is that the preferred partner invests in a deeper relationship with NVIDIA. These partners work to achieve training, revenue, and other goals and are rewarded with additional benefits. Now, there isn't even the highest tier. There's an elite tier above that. So I don't really know exactly what that means, but definitely another thing to consider is they are forming good relationships with NVIDIA. So contracts for data center usage, contracts for energy, they have quite a good moat there. They also have a disruptive business model because they're, most of these data centers are placed in cities where land is expensive, energy is expensive. They really kind of crack the code here, and they are in super remote places in British Columbia, remote places in Texas with access to super, super cheap energy on top of the contracts that lock in cheap energy. So just really great. They can offer really competitive prices, which means they should be able to even take more market than, grow faster than the whole market's growing, because they'll be able to take market share because they're one of the lowest cost producers. Cheap energy. On top of that, their moat is also management. Management people is a moat, and you have these incredible managers that are willing to pivot if they must. So management is also a moat in my opinion, and they'll just use that energy to whatever has the best return for shareholders. And they have a track record of completing these infrastructure projects, which is also a moat. That knowledge, that company knowledge of how to build these kind of projects is also a moat. Industry mature market caps, it's super hard to compare because this whole industry is growing like crazy. So I think the better thing to do is look at what revenue could get to, what kind of multiple you can put on that, and what does that mean for the market cap. Net margins for data centers, you see somewhere between 15 and 30%. They're already at 18%. So we'll see in my projections on where we think the net margin might get to, and what that means for the return. So PEs are all over the place because we have unprofitable data center companies. We have data center companies that do a million other things like Google and Amazon. So it's a bit hard to compare these PE price to earnings, price to sales, and price to book ratios. With that said, we'll take a look back at IREN's price to sales, price to earnings things. Obviously, with a 97 price to earnings and a 20 basically price to sales, one could say it is a little bit stretched in the short term, which is fair. But I think if we're really looking at the long term, if they complete these 660,000 GPU build out, any price between 37 and if it goes back to kind of this support level around $20 or $15, anywhere from $15 to $40 is probably an incredible price. So you could buy some now at 37, and if it dips, buy more. I think if you have a long-term view, it just makes those kind of decisions way, way easier. We're not into day trading here. So, we'll make more of a definitive conclusion on whether or not I think it's still a good deal at these prices in a moment. So, all right, the bear case model. So 75%, which would be honestly pretty awful. We'll look at their letter. So they are currently here saying they're generating 1 billion of annualized revenue today. So if they took their current revenue generation per day today and annualize it, they're saying they're already generating over 1 billion of annualized revenue today. So at 75% growth, they get to that 1 billion. So that's basically do nothing scenario. And then basically what I have here in the modeling with this 15, 12, 10 kind of tapering down 10 to 5%. And then finally, after 10 years, basically the bear case says they complete their 660 GPU build out to that $33 billion of revenue in the 10 to 20 year time frame. So that's the bear case. It takes them way longer than they expect to really finish building out all of these GPUs. And again, the modeling is really just supposed to give you a directional idea of what could happen. This is not exactly what's going to happen. I mean, I'm throwing in 5% here, a bunch of years, and then tapering it down to 2%. So this is just supposed to be really conservative and not supposed to be definitive. I can't see the future. So now, base case. I think this is the much more likely scenario. They grow 135% this next year. So that means that they add an additional $177 million of revenue on top of what their annualized current installed, kind of revenue generation is. And then, like I mentioned, they kind of get to this $33 billion run rate in the 5 to 10 year. We only really care, we compute out the 1 year return, the 5 year return, the 10 year return, the 20 year return, because we are long-term investors. So basically we're not going to get it perfectly right. So we're just getting a general idea of what these different scenarios look like. So bear case, it takes them 10 years plus to finish the 660 GPUs. In the base case, it takes them 5 to 10 years to build that out. And then in the bull case, they complete it in the 1 to 5 year range. So in year 5, they have that $33 billion of revenue. And this is basically kind of based off of this, which is the typical time to develop a data center. So you have site selection, which is 6 to 12 months, permitting and approval, which is 6 to 18 months, design and development, 9 to 18 months, construction, 12 to 36 months, energy procurement, 6 to 12 months. So you're looking at a total of 3 to 6 years. But it is important to note that IREN has some of these things finished already. They already own the land for the major 660,000 or 600,000 site. This is the Sweetwater hub, where they are planning on putting in 600,000 of those 660,000 GPUs. And you can see here a picture of it. There's already equipment being moved in, and they own that land, and then you have the power infrastructure there in the background. So they are kind of far ahead. So, even the base case might be too conservative, and we might find that the bull case is the most likely with a time frame like this, and them already having completed a lot of these steps for this data center build out. So just keep that in mind. The next thing to look at is the profits. So in the bear case, they're currently at 17-18%. So we're saying profit margin is less in a year because of cap expenditures. Goes back to where it is now in 5 years, and then slightly improves up to 20% in the 20 year in the bear case. Base case, we say that continues to improve from here. So 17-18% to 19% to 21% to 23% with a 20-year net profit margin of 25%. And then in the bull case, 20%, 25%, and then kind of a long-term profit margin of 30%. You have companies like Microsoft who have, I think, a 40-something% net profit margin. Maybe it's in the 30%. I'm not exactly remembering right off the top of my head, but you can get really, really strong net margins for these kind of massive companies that are doing data centers. Now, again, Microsoft isn't just data centers, so there's software in there, so it's a little bit hard to completely parse out just what their net margin is on data centers, but in the bull case, they get to 30% nonetheless. So, all right, let's go to PE ratios. Bear case, they come down to 25 PE and kind of trade at a 20 PE in year 20. In the base case, which is again kind of our most likely scenario, they're trading at a 50 PE in 1 year, a 35 in 5, a 30 in 10, and then a 20 year of 25 price to earnings. In the bull case, they are trading at still a 100 PE, which is basically what they're trading at now in 1 year, a 55 in 5, a 45 in 10, and then a 35 in 20. The last thing is to look at share dilution. Like I mentioned, they are not doing this anymore. In the bear case, they don't do any share buybacks. In the base case, also no share buybacks, and then in the bull case, they buy back around 5% of the shares outstanding. So I think this could be much, much higher in the long term if they are just generating massive amounts of revenue. Again, I think it's up to management, and I think they will continue to do whatever is best in terms of returns for shareholders. So this could be a little bit conservative for the share buybacks, but we do have that calculated in there. Before we go look at it, we'll just go look at our final buy checklists. They are innovative in terms of their product and business model with these kind of remote data centers. They're not necessarily a generational leader. There's lots of data center offerings. They do have top fundamentals in terms of margin growth and net assets. They are founder run. They are insider owned. They aren't necessarily disrupting, like they're not going to make Amazon's data center business go away. It does have, in our opinion, a 30% plus return likely. It is not necessarily undervalued. I'm actually going to switch this to false. I think looking back, you can't really say it's undervalued. Looking forward, I think you could definitely say it's a good investment. But looking back, I don't think necessarily you can say it's undervalued at the moment. Insider buying, last time I checked, I must have marked that as true. And the coma test, I do think you could literally go into a coma for 10 years and be very happy with this investment. So it's getting a 70 out of 100 score. So now let's look at the returns. Just zoom this out a little bit. So in our base case, we have IREN with about a 1.3x, so about 30% upside in the 1 year. So obviously, again, most of their upside is really dependent on this massive 600,000 GPU build out. So it's really dependent on when that happens that you see, kind of all the return. And it could be incremental. So maybe looking at it as a, binary moment isn't the correct way. You could start building this out and having some of the GPUs online by year 5, and then, the rest of them online by year 10. So it may not be as binary of a moment as I'm modeling, but it'll give you a little bit of idea. So this is the base case where they don't get it. They get the data center, all the GPUs built out in the 5 to 10 year. So the 5 year doesn't look that great either. I think this might be a little bit conservative. I might be putting too much of the revenue growth on a singular moment. So definitely keep that in mind. But in the 10 year, you see that 31x return. So, and we'll just quickly look at the 20 year as well with the 47x return, which is one of the better in the chart in our modeling currently. So looking at the bull case. So this is 1 year, a 2.7x. So this is basically just, this idea is just, the 1 year upside is more on, a valuation multiple, so higher PE ratio, etc. But this is them completing the data centers in the next 5 years with a little bit more bullish margin levels and PE ratio on that with a 51x return in the 5 year, 78x in the 10 year, and then 173x in the 20 year. Now, bear case, what is the worst case? What happens if everything goes wrong? Because we want to make asymmetric bets here. That is what we're about. We're about making asymmetric bets. So is this an asymmetric bet? Obviously, in the 1 year with its currently super stretched PE ratio, you could see about 70% downside for it to be, valued at 25 PE, which I think is very unlikely for a company growing revenue this quickly. And then the 5 year with 30% downside from the current stock price, And then remember, in the bear case, they don't complete this 660,000 GPUs until, you know, the 10 to 20 year range. So in that 10 to 20 year, you pretty much make everything back that you kind of had dead money for 10 years at. But even in the bear case, you have this 20-year 17.5x, which again, the S&P 500 is expected to 6.7x at a 10% annual growth rate. So even in the worst case scenario, in the 20-year kind of modeling, it still has a far better return than the S&P 500. So I still view, even at the current stock price, this to be a very, very asymmetric investment for the long-term minded investor. So quickly, want to make sure I didn't miss anything. Yeah, 501 million in revenue, and that is with only 1.9K GPUs installed. They are generating the 1 billion in annualized revenue. I'm just basically covering what they went over in their latest earnings call. Okay. It was letting me click this and go to it a moment ago. Now it's not, but I have them highlighted. So 501 million revenue trailing 12 months. They only have 1.9K GPUs currently installed in AI capacity. Go down to the next highlight here, which is I should be the generating 1 billion in annualized revenue. Something about my highlighter tool isn't working. But they are approaching 1.25 billion in annualized revenue if you include their current run rate plus what they're building out in AI cloud. Let's see some of the other highlights. Yeah, all my highlights have stopped working for some reason, but I'll just go over it here in the side. So yeah, they have path to 60K NVIDIA Blackwell GPUs at their British Columbia sites. They have 19K NVIDIA GPUs at the Horizon 1, which I believe is in Texas. They have capacity for 600,000 liquid-cooled GB300s at, this is the Sweetwater project. So it might even be more than 660K. They don't give a total number, which is a bit annoying. So I don't know if this is calculating the 19K in this 600K. Not exactly sure. So it could be even higher than 660,000 GPUs installed. It could be with an additional 19,000 on top of that. Like I just mentioned, they're approaching the 1.25 billion total analyzed revenue. This is a really important thing that I've touched on a few times, which is optimizing capital structure. Again, this is just a really competent team at funding these kind of projects. So really, really great. And then, like I mentioned before as well, just really good stockholder equity. So yeah, that concludes today's video. I hope you learned a ton, and more importantly than just learning about IREN, I hope you learned a ton about how we view investing here, that you can apply this framework that we use to look at IREN to any company that you're interested in, having that long-term mindset, you know, do the modeling, do the work, understand the leadership team, understand how they're going to achieve growth, you know, write down your thoughts. I think that is the most important thing that I hope you take away from this video. I hope you learned a ton. I hope you were entertained. Thank you so much for watching. If you enjoyed, make sure to leave a like and subscribe for more content like this in the future. And have a wonderful day.